We're here at REIT Week 2009 in New York at the Waldorf Astoria Hotel, and we're joined by Sturzenegger and Jeff Horowitz of Bank of America Merrill Lynch. Recently, Merrill Lynch and Bank of America merged. How has this impacted your operations?
If you look back at the history of real estate investment banking, two of the more prominent franchises out there were the Bank of America Securities franchise and the Merrill Lynch Realty franchise. They were both very strong, both from a debt, equity, and M&A standpoint. Bank of America came at it, Bank of America Securities, primarily from a very strong balance sheet and debt and distributable debt, CMBS, but also strong M&A. And Merrill came at it with a very strong equity and advisory business. And we put those two fully built, fully developed teams together into a single platform. Really, we did that this year between January 1st and January the 30th, so that we had strong debt, legacy BofA, strong M&A, legacy both, and then strong equity, legacy Merrill Lynch. And when we put that all in a combined platform, we became unbelievably powerful to our clients. And a lot of the equity or the re-equitization we have seen in the REIT market has come from a combination of, at various times, Bank of America Merrill Lynch modifying bank lines, at the same time going out to the equity market, plus the thing that sits in between is the sort of recapitalization advice.
Bank of America Merrill Lynch has been the lead book runner in a number of the recent secondary equity offerings by REITs. Who have been the major investors in this case? Institutions or hedge funds?
You know, a lot of these started out with the dedicated players. Dedicated players only do have so much money, though. And so as we've looked at the last 30 or 35 deals or so, we've found that we've allocated the stock around 40 to 50% to the dedicated real estate players, another 30 or so percent to long-only mutual funds. There's probably been about 10 or so percent to hedge funds, and 0 to 10% retail. It's
interesting. I think, Jeff, we've raised roughly $12 to $13 billion now for these REITs. There wasn't $12 to $13 billion of capital available in the dedicated REIT funds. So to some extent, we had to bring in other investors, and we would not have seen the rally we've seen and the re-equitization we've seen without having some non-traditional REIT buyers see the opportunity to recapitalize the space and jump in. And I think part of the success that we and other investment banks have had is being access a different pool of capital that we hadn't gone after before, that we were able to go after at this particular point in time, because they saw the opportunity to re-equitize these REITs, and quite a few of them, once they took out the sort of illiquidity discount that was in the shares, you saw a lot of these stocks go, what, 15 to 30%?
Yeah, we've seen since we started doing offerings towards the end of March, probably 30 to 40% increase in the price. And I think that as deals work, that leads to more deals working. And as deals happen, you'll find that more money flows into the sector as people don't want to miss something. So we've seen much broader participation. Many of the mutual funds were unallocated to real estate a few months ago, and now have begun to have a legitimate allocation.
The fundamentals in the commercial real estate industry are under heavy pressure. How has this impacted investors' enthusiasm for REIT stocks?
As the buyers look at these stocks, and certainly have over the last couple of months, they've seen stocks they thought were unfairly cheap. The shorts had pushed them down hard. There was a tremendous decrease in price because of the illiquidity and worry about leverage. As we've created some openness in this marketplace for equity capital, I think people realize that some of that fear may have been unfounded, and the stocks have moved up pretty rapidly. I think that the investors are also looking at this as really part of an initial phase of re-equitizing the equity markets, the REIT markets. And as they put money into these, they realize they're getting a ground floor, large-scale interest in some of these companies, which they expect will be large acquirers of assets over time, certainly opportunistically over time. And this is just the first of several rounds of that, so they're getting their basis in.